Hey everybody, Tony here for part 3 of this week's Vega, Theta, and Implied Volatility lessons. If you didn't watch part 1 and part 2, I went over what Theta was and what Vega were. In part 3, I'm now going to talk about Implied Volatility, why it's important, and how Vega and Theta both tie into Implied Volatility. So we'll try to keep this as short as I can, but essentially IV or implied volatility is the expected change within a stock's future price. So the higher the IV or implied volatility, the higher expected change in that stock's price. And same thing, the lower the IV or implied volatility, the lower the expected change within that stock's price. The IV plus the time value is how we calculate options premiums, and the implied volatility, like mentioned here, represents the extrinsic value that exists within an options contract relative to that expiration date. So it's important to know, like I said earlier, the higher the IV, the higher that expected change is. The lower the IV, the lower that expected change is. I get asked a lot, what is a high implied volatility or what is a low implied volatility? Well, to be honest, that answer varies depending on the stock you're talking about. There may be a stock that, on average, the IV is around 60%. But for a stock, that may be extremely high. It really just depends on the stock. There's stocks that trade, with around a 20% IV, which could be high for some, but could also be low for some. So it's very dependent on the stock. And to calculate whether an IV for a specific stock is high or low, you can use something called an IV rank, which I'm going to talk about next week, and how you can kind of calculate to see if something has a high or low IV for that specific stock. Now, how does Vega come into play? Well, when the IV changes, that Vega value comes into play. If you remember, for every 1% change in the IV, that Vega value then affects the price of that options contract. Also, the higher the IV or lower the IV, the higher or lower the theta or time decay, and we talked about that in part 1. So that's something else important to note. Another thing is this chart here on, how to calculate an expected change with a certain stock and the implied volatility. If we look at this graph, let's say a stock's $50, and the implied volatility is 20%. With every one standard deviation move, that stock is expected to move $10 in either direction. And next week, I want to talk about how implied volatility and standard deviation coincide with one another, and how they, are working together. So just a quick recap, guys. The higher the IV relative to that stock, the higher the expected change. The lower the IV relative to that specific stock's IV, the lower the expected change. It's also important to note, as an IV for a specific stock gets extremely high, the chance of it reverting back to that mean drastically increase. And the same for something that has a low IV relative to its average, the chance of that increasing back to that mean, become greater. So I hope this lesson helps. Next week, I want to talk about how implied volatility and standard deviation coincide with one another, and I'm also going to talk about how you can calculate something's IV and see if it's high or low relative to that specific stock. So I hope this lesson helps, guys, and I will talk to you soon.